Hi there, it's Eric Bennis from the team here at John Graham & Associates, and today we're going to be discussing 6 keys for more successful investing. The first key is to always think about long-term compounding. So when you go to invest, typically, especially if you're going for retirement investments, you're thinking about the long term. And what does compounding actually look like? Because it is a very powerful tool. So imagine this scenario. You have $10,000 and you invest it for the long term, right? And it makes 8% a year on average for 20 years. Well, I know you only started with $10,000, but actually at the end of those 20 years, you end up with over $46,000 simply by being patient and allowing the money to compound. Now, the real power in long-term compounding is the longer that we wait, the more rapidly we can advance that compounding. So remember, in our previous scenario, we waited about 20 years and we made more than 4 times our initial investment. Well, let's say we wait just another 10 years. So now we've put in $10,000 and we've waited 30 years, right? At that point, you not only double your investment, triple your investment, quadruple, you've actually made well over $100,000 off a simple initial $10,000 contribution. Now, what you have to remember is you left it in, we assumed an 8% average annual return, and you didn't make those withdrawals. So you have to leave it in there and allow it to compound over time. And that's where the power of compounding comes from. So tip number 2 is you want to be able to endure short-term pain in exchange for long-term gain. What I mean by that is every once in a while you're going to see in the news, you're going to see the red lines with the arrows going down, and they're going to say the stock market isn't having a good day. It's a bad day for Wall Street or something like that. And you want to be able to stick with your initial plan that you and your advisor came up with. And you want to be able to endure that initial discomfort that you're going to experience here and there with the market ups and downs, because you know in the back of your mind that long term you are averaging that 8%. You are doubling your money, tripling your money over time. So having the discipline to stick with it is incredibly important. So tip number 3 is to pick an appropriate asset allocation. And this is the step where a lot of people start to involve a financial consultant, such as somebody on our team. And the reason for that is not a lot of people necessarily feel comfortable picking their own asset allocation, and then obviously making the necessary adjustments throughout their life as circumstances change, both in their life and in the market. But it's a very important step, because if you don't start off with a good foundation, everything you build on top is not necessarily going to turn out the way you want it to. So it's really important to get that asset allocation correct and think about, what are my goals, what are my timelines, all those things when you're picking that asset allocation. And again, if you don't feel comfortable doing that, that's what we're here for. So give us a call, and it's something that we do every day. The 4th tip is to understand your time horizon and have a plan for what you anticipate in your life. We all have unknowns that come down the road that we weren't expecting, but certain things we are able to anticipate. So let me give you an example. If you have, let's say, $100, you don't necessarily want to invest all 100 because you want to have some for your short-term savings, because you're going to have the water bill due next month. You're going to have, the new car that you've been planning to get now, and you know that you're going to do that in 6 months. A lot of these short-term things, you might not invest in the same way that you do your long-term stuff, such as your retirement. So it's really important to have that discussion with the person that you work with, if you work with an advisor, in order so that they understand that they have to set aside a certain amount for different goals, because often somebody will come in and they have many different goals, and the way that you invest is very contingent upon what you're trying to achieve with that money. So tip number 5 is to take advantage of dollar cost averaging if you can. So what dollar cost averaging basically does is it means you make an equal and periodic investment that takes advantage of the fact that stocks, mutual funds, everything, the prices go up and down over time. That's what the market does. It goes up and down. But if you're making periodic investments, sometimes you'll buy it a little higher, sometimes you'll buy it much lower, sometimes you'll buy it right in the middle. And the end result of that typically is that you'll end up actually paying less per share of whatever it is you're purchasing than if you made a single lump sum contribution. So for example, let's say that you want to invest for your retirement and you're still working, so you should have current income month to month. Instead of maybe waiting until the end of the year and then writing a big check for $7,000 to put in your IRA or something like that, where you end up purchasing, let's say December 20th, whatever the prices are that day, that's what you get. If you were to spread it out over the 12 months and make a monthly contribution to your funds, you're able to take advantage of that dollar cost averaging, and it will likely end up helping you get a better price per share in the long run. Our last tip for today is don't just buy and forget. You've heard the phrase buy and hold, which means to purchase something and be patient for it to rise in value over time. But there is a difference between holding and completely forgetting about the account, because you do constantly want to be reevaluating where you are in life, where the account stands in relation to different market changes, and you want to consistently review that account. So that's something that we do as financial consultants. Is we of course review these accounts, but we make it a goal to sit down with our clients to make sure that what we're doing still lines up with what they're trying to do as well. There's plenty of instances, for example, where a family has a baby and goals change. So often, if you start an account at a young age, by the time that you're 60 years old, there's going to be numerous changes both in your life and in the dynamics of how our modern economy works, and all kinds of other changes that could come along. So you want to be consistently communicating with your financial consultant so that they're aware of any big changes in your life. And you want to sit down and take a look at your portfolio and make sure that it still matches what you're trying to achieve. Thanks for watching. If you're interested in seeing more videos like this, we do have a YouTube page with more videos. It's Invest with JGA. And then also our website, if you want to check us out and learn more or reach out to us, is investwithjga.com. See you in the next video.